picnic?
Yeah. Yeah.
Very nice. Hopefully people are interested to hear from you. And I know we spoke a little bit beforehand on all these topics, and you may have some unique insights for us.
We shall see.
Yeah.
We'll see. It's funny because, now when I talk on things like this, when I talk to the press, about the book, everyone's like, all right, yeah, it's great, but what about now, right? Nobody wants to know about 20 years from now and predictions long-term on robots and things like that. Everybody just wants to talk about what's going on now. And so there may have to be an addendum to the book in some way.
Later, you'll write a book about what happened this year.
You're seeing history unfold. I mean, the whole point of the book is what can we learn from the history of work in the current state to predict the future. And the current state is historic and is accelerating the future. So there is a great book or two to be written, but certainly the framework in my book is very applicable to everything going on now.
Cool. We will get to it. I see we have around 50 people who've gotten on, and I want to be respectful to their schedules. It is wonderful to have you, Jeff. So we've been doing this Flex Forward series with folks that know a lot about one thing or another, about this whole world of work. Sure. Unusual time that we've been in. We had all kinds of folks up and down the sort of real estate economy stack, somebody who runs a big giant debt fund and acquisition fund. We had somebody who watches all the REITs and the office investments. Had the heads of real estate and office for lots of big companies. We had the Uber person, someone from Dropbox last week. And I think the stuff I'm interested to hear from you on will be hugely additive to all that as we're trying to figure out what's going on. We gave the title this Jobs, Commutes, Collaboration. Sure. I think you're gonna have a lot of thoughts well beyond that. And I want to hear about your exciting new book. I don't know if I made it to the back cover as one of your plaudits, but you were kind enough to share the preview of it a month or 6 weeks ago. Yeah. So thank you for that. So I've got Jeff Wald with me, and I'm Amol Sarva, the CEO of Knotel. And Jeff and I have been friends for a long time, long before I think you started the company WorkMarket. Yes. And all through its exciting career and then acquisition into ADP, which is I think one of the biggest employer services companies in the world. It is. So thank you and welcome. Maybe a place to start is just about you. Do you want to talk to us just about you, WorkMarket at least, if you don't want to go all the way back to your childhood? Of course. And where you're at now with ADP?
Well, first and foremost, thank you for having me. Always been such a huge Amol fan, always been such a big fan of Knotel. And we knew each other well before WorkMarket because you were there when my first startup spectacularly failed and bankrupted me. So, you've gotten to see the lows, and now we've, been very, very fortunate with the outcome with WorkMarket. WorkMarket is an enterprise software platform that enables corporations to organize, manage, and pay their freelancers. And so as companies increasingly engage an on-demand labor force, they lacked these systems and processes to engage that labor force efficiently and compliantly. And so our software helped plug that gap. We raised about $60 million from Union Square Ventures, SoftBank, and a few others, and were purchased in January of 2018 by ADP. And ADP, as you point out, is the largest human capital management company on the planet. It's a software company. We obviously are most well known for our payroll services, but we're actually the largest human capital management software company in the world. And it's just been an amazing, amazing place. And I will certainly say that, super fortunate to have been bought by a very big company before the storm. So we have just, had an amazing experience within ADP as ADP looks to provide to its customers a total talent solution incorporating W-2 employees and on-demand employees. So our products are increasingly weaved into ADP's human capital management offering, and it's been a great experience.
I think I get my occasional paychecks from ADP, as I suppose, 50 million or 100 million people in America do. Is that like that?
We are by far the largest provider of payroll services in the world. I mean, by far.
Wow.
And so we
Okay,
actually have
which
more,
means you know a little bit about jobs, yeah?
we do. We have more data on the employment market than anybody in the world. And, you know, that is why the monthly employment report that is put out by ADP is one of the most watched barometers of economic activity. We certainly know who is hiring and who is firing. And
Yeah.
obviously in the last 8 weeks, 36 million of our fellow Americans have lost their jobs, and it's an unprecedented economic and health crisis that we're in.
Yeah. I think for anyone who's been watching or even just awake, the staggering scale and speed of this thing has not been lost. But tell us something we don't know about what happened this last 6 or 8 weeks. Something beyond just the 36 million, 3 to 5 million a week, you know,
so
15-20% unemployment, minus 5% GDP Q1.
Yeah, let's talk about the remote workforce. A lot of people don't know the statistics. And one of the points I try to focus on in the book, you know, I've been asked a lot, why did you write this book? I wrote it because I was getting a little frustrated with conversations that would happen around the world of work that were not based in evidence, that evidence being historic trends, that evidence being data on the world of work today and data over time. So let's start, you know, this whole conversation around what's going on now with data. 1.5% approximately 10 years ago, 1.5% of the labor force worked remotely, meaning more than 50% of their time they were not in the same office. And that doubled. Pre-crisis, 3% of the US labor force worked remotely.
Right, and that is a surprisingly low figure, right?
It is a surprisingly low figure.
The average sort of person, you'd think, oh no, it's really high, you know, but it's 3 is like nothing.
3 is very, very low. The United States has the largest percentage of their workforce that can work remotely of any country in the world. 42% of the US labor force could, in theory, work remote, meaning those that can't work remote, barbers and police officers and firefighters and manufacturing and a host of other things can't work remote. The US has the largest professional services sector and a host of other sectors that can work remotely. So it's important to keep in mind that when you talk about the percent of the labor force working remotely and make predictions about what might happen, you know, I saw one prediction the other day, 50% of the labor force is going to work remote after this. And you want to go, where are you coming from with your numbers? Like that's it's just dumb. And so prior to the crisis.
We'll get into that 42% though for a sec. So it's like call center worker, software engineer, marketing department, you work on your computer or on your phone, you deal with information.
Sure. Professional services, accounting, consultants. I mean, just anybody that it does not have to physically be in a location where they are meeting up with either large equipment that can't be moved into a home setting, or directly with the consumer.
Okay,
That retail employee can't work remotely. Like their whole job is to be in their retail location.
But also on that 50%, so when you said remote workers, 3% of them spend more than half their time at home / remote.
Yes.
Pre-crisis. That's more than half, but that's not all. That seems like an interesting distinction. What are they doing the rest of it?
The rest of the time, you know, they could be hoteling. They could be coming into the office for whatever meeting, right? Everybody in corporate America is designated to an office, right? Just knowing this from HCM systems. You have an office you're assigned to, you just may not be going there. That office can be designated as your home. And so the question becomes, if people are designated in their home office, they are clearly a remote worker. People that are designated to a specific office, but aren't there more than 50% of the time, which is a very important thing that companies need to track for tax nexus on that person, then that person is deemed to be remote. So a salesperson is the person that usually comes, is the nice archetype to talk there. A salesperson that's on the road all the time might be a remote employee. They're only in the office 1 week a month.
Right. And, you know, I guess our lens on this at Knotel, right? We run 400 offices in 10 countries around the world. And we consider a similar factor. Pre-crisis, the average utilization rate, which is how many people are at their desk on a Tuesday back in November, it was only 80%.
Right.
So on any given day, 20% aren't there. So
Yeah.
everybody's kind of a remote worker a little bit. They're not above that 50% that you're given. Everyone's sometimes on a trip, someone's at home. Like, that has already been part of our culture at this point.
That is
But perhaps that number is going to change. That number is going to change.
Maybe. I mean, look, the 50% is important for a few reasons. And we're going to get into some of the impediments as to why there wasn't not more people working remotely in a moment. But the 50% is important because it has two implications. One is tax, right? And where their tax nexus is, where you pay payroll tax. Because if that person is constantly remote, you might have multiple points of nexus. And so the 50% won't waver from a tax standpoint unless tax law change. Unlikely. The second is the need to build infrastructure for that person. If they are coming in more than 50% of the time, they kind of need a desk. They need a place to be versus just a hotel desk, right? Where they could just go in, plug in their laptop and go.
Sure.
And so do you build infrastructure for the person, point A? Do you have tax nexus for the person, point B? Those are the things that help determine and are the impediments or cost structures associated with the remote distinction.
Okay. So that is clarifying and helpful in understanding how the 1.5 became 3% pre-crisis, and it tells us that 50% of the whole world's going to be remote in the future. Seems nuts. But then, what would be your best guess on where it gets to? Because certainly something has changed. Maybe tax nexus didn't change, maybe infrastructure didn't change, but people did suddenly become a lot more comfortable with that colleague not being in the meeting live and whatever, right?
100%. So pre-crisis, I would have made the statement, we're going to go from 3% to 4% over the next 10 years. And we're going to do that because the infrastructure to enable remote work, the Zooms, the Slacks, and all the things that we've all become so familiar with over the last few months, they didn't really exist, or they didn't exist in any great way 10 years ago. Now they exist, so they were help driving that 100% growth over the last 10 years. Well, they'll improve over the next 10 years. They're not going to improve so much from non-existing to where they are now. They'll get better. Point one. Point two is that the most of the low-hanging fruit of people that clearly could work remote had been done. And so you weren't going to see another doubling. And then the last point was that most remote work, and this is the most important point for thinking about the future, most remote work was done under a pull context, meaning me as the employee was saying, I want to work remote. I need a flexible work arrangement because of other stuff in my life. I want a flexible work arrangement because that's just the way I want to work. And it was mostly only top performers or people with very specific reasons that were granted it because companies were resistant. This was never a push, hey, we want to get everyone working remote. It was a pull. Now, obviously going into this crisis, companies were forced to do a number of things. The most important of which was put in place the infrastructure from a technology standpoint, whether it's IP tunneling, whether it's VPNs, whether it's access to certain databases and other kinds of things, and put in place the policies and procedures. What does it mean to have a remote meeting? How do we follow up? What are the cadences going to be? All of those things were things companies really didn't do, right? A lot of companies didn't let people work remote because no, we can't have anyone access our systems. There's no secure way to do it. Now they had to do it. They didn't do it great, by the way. And so Zoom bombing is the least of people's concerns when it comes to the holes that have been created in a cybersecurity infrastructure standpoint, but they did it. They did it well enough. And so now the infrastructure is in place. The policies and procedures are in place. And importantly, the mentality has changed. This notion of, no, people can't be productive if they're not in the office. Presence equals productivity. Magic happens when people are in the office. People always thought that, or let me say it differently, very old school managers thought that. And they would ignore the statistics. I remember a conversation with a C-level executive at a very, very large corporation. And he said, look, I think everyone's got to be in the office. I was like, but based on what? He's like, well, that's just what I think. I said, all right, well, let me show you the study by Google. Let me show you the study by Stanford. Let me show you the data that says remote workers are happier. They're more engaged. They're more productive. cost less, they're more environmentally friendly, they have a lower attrition rate. Here
Yeah.
are studies that say these things. And he goes, yeah, but that's
So
what I
then what's
think.
the prediction? So you're taking us through the reasoning here. You surprised us already when you said it was only 3% remote before. Then you
8%.
surprised me that you thought it was 4 before, that it was heading, and now you think it's going to be 8.
8.
In a
Yeah.
decade.
In a decade, with a very quick ramp up to 5 or 6 as we start to come back. I think you see 5 to 6% of the labor force stay at home.
Mm-hmm.
Now, that prediction is based on the recent surveys by Gartner that they've asked, the Fortune 500 CFOs, what percent of their labor force they think will stay remote. The answer was 5%.
Mm-hmm.
That prediction is based on certain industries, and which industries are seeing productivity increases, because I've heard that a lot.
Yeah.
And where companies, are going to be able to start being flexible with their office space. So people are going to want to start to engage in much more flexible office environments, because they are going to start decreasing the number of full-time people that are in an office, right?
On site. Yeah. Although, I mean, now that you've helped us bound it, you're thinking it was 3% before, in a year or two, it'll be 6%. So remote doubles, but as a part of the workforce that perhaps in aggregate isn't huge. In some companies, it'll have a big effect. I want to inspect now another aspect of this sort of hybrid, the person who's not fully remote, who's just always a little bit remote. That percentage probably has to change a little bit too. And I wonder if you've seen any evidence about that. I mean, we ourselves have been watching what our customers want. In the first few weeks of this, I think people were very happy and excited to be at home and not commuting.
Right.
And a few weeks into it, when we surveyed again, the overwhelming majority, well north of 80%, were just eager to be back in the office, at least a little bit, like, Jesus, get me out of here,
Well,
and what's your feeling?
A lot of that is driven. I mean, I think the surveys are a little difficult right now because you're seeing a lot of exogenous factors. One, there's no childcare. So I think anybody with children, not having children,
well, schools
careful
are
about
shut.
what I say. Schools are shut. They don't have childcare. They just want to be somewhere else than where they currently are. So let's leave that aside for a second.
Right.
And then there's a general societal depression of, oh my God, the horror going on around, which I totally understand and obviously have felt myself to a great degree. So it's difficult to understand what people's intentions will be as we start to get back into the office as lockdowns are lifted. So thinking about the next 12 months before, God willing, a vaccine and wide distribution of that vaccine, or at least therapies that are incredibly effective, I think is very different than when we kind of get back to all right, we can be a little normal. And here's what I mean by that. First, the 3% increase, a kind of 3% where we are now to 6%, keep in mind, that's 5 million people. That is 5 million workers in the United States of America. Also keep in mind, our max point is 42%. And so by getting up to 8%, I'm saying that almost 20% of the people that could work from home will work from home or remote. But I 100% agree with your point that you will start to see a lot more flexible work arrangements where hey, can I work from home? What did everybody used to think when somebody said, hey, I'm going to work from home tomorrow? Everybody would be like, oh, all right, so you're not going to really be doing anything. It's not going to be like that. People will start to have 4-day periods in the office. People will start to say, hey, I'm going to work from home next week because I got to take care of this, this, and this. And it will be much more acceptable. But does it change the tax implications of where your nexus is? No. Does it change the need to have infrastructure for that person in the office?
Sure. Great news for Knotel, right? They still need a Knotel for that, or a desk for that person.
Many reasons that I'm bullish on Knotel. That is certainly one of them. Its leadership is
right. Well, that is too kind. All right, so we've been inspecting a little bit remote, and we've kind of been talking about your book, right? But I do want to get some insights and some facts on what's going on in this economy and in this labor force. Certainly the last few weeks, and I won't necessarily press you to give bold predictions about the next few months, but maybe one access point into this, because we're seeing the big headline job loss numbers, right? Yeah. And I wonder if you have some insight into the differential impact on either different classes in society or verticals across industries. I mean, Disney laid off 100,000 people. Well, anyone in the arts, entertainment, theme parks business is devastated. Restaurants, I suppose retail, hotels, travel, airlines. Are those the predictable places where all these carnage is?
It certainly is. Look, this is another area of U.S. bullishness. While the whole world is obviously just, let's leave aside horror for a second, the United States has one of the lowest percentages of our employment and economic activity that comes from retail, leisure, and travel. At 16% of the US economic output and employment is associated with those industries, all of which it is tough to imagine the scenarios in which there is a V-shaped recovery for them, in which outside of a vaccine, people feel comfortable at the level they were going before of going to a theme park, going to a movie theater, going to a restaurant, and things like that. People will go back, but will they go back to 100% the levels they were before the crisis? I hope so, but I think that's a tough thing to get.
Yeah, I don't see it. Right, I don't see it. And actually, I have a perspective on the supply side, right? We think about office at Knotel. And you were laying out the case on the demand for office, like the behaviors of the people. On the other side of it, we know we need to redesign these things to have more space per person. It's just going to be more spread out. You used to have an office that would accommodate 100. Well, that office now accommodates 50. And that's kind of helped by the fact that a bunch of people can and will work from home and whatever. But that's also true, I think, for some of these industries, right? I mean, I haven't yet seen what the airlines plan to do, but a restaurant's not going to be shoulder to shoulder. You're not going to ever go back to Oktoberfest with 1,000 people all falling over each other. Some of these things just have less revenue producing capacity, I suspect.
Well, I think there's a argument to be made for capital improvements and the amount of capital spending to be made in a period of time where behavior patterns are not going to adjust or will adjust to what is the period of time behavior patterns do revert to the norm post a vaccine. And so how much, are you going to completely reconfigure an airplane and the way seats are set? Maybe not. Will you just say, hey, we're only selling every other seat for a period of time? I don't know how many capital investments people are going to make, because I'd be willing to make the bet that once there's a vaccine, people behavior patterns go back to very close to normal. I agree with you, people may not want for a period of time to be shoulder to shoulder, but again, not everybody, right? The Economist, as The Economist always does, had a great article called The 90% Economy, where people are going to go back to restaurants, they're going to go back to movie theaters. It's just the marginal person may not. And the marginal person is where a lot of profit is derived, right? To get your, you can get to the 70% to cover your costs, and then that next 90%, or, you start getting operating leverage, that final 10%, your operating leverage really kicks in and you're making a lot of money. Those last 10% of people may not come for a while, but is it enough to have you make the capital investment necessary to reconfigure?
Yeah, wise. What else have you seen from job losses? So we talked a little bit about industries. What about classes, levels, income ranges, geography?
So I won't pretend to have a lot of data on this. What I'll say is, one of the things that we certainly studied in the book is the gaps that open up in society whenever there are huge changes in technology. And so the point of the book was to give historical context and a deep data dive context into the history of work and our current state in order to help understand how robots and AI might impact the labor markets, because that was the big focus and still will be. And when I talked about this in the book, I talk about the fact that, to me, the doom of Skynet, it's just the term everybody in the labor world uses for the doom of robots and AI. The doom of Skynet, to me, is not robots and AI taking all of our jobs. I make a prediction in the book of no net job losses. No net job losses. But still a lot of jobs lost to robots and AI, just job increases in other areas to make up for it. The doom is retraining workers, 25 million workers that are in jobs that won't exist, that need to move to jobs that will. And so to me, the doom of Skynet is not technological unemployment, it's the exacerbation in society of the gaps that exist, because those 25 million jobs are low-paying jobs. They're jobs in retail and in transportation, and a lot of the industries that are being hit so tremendously right now. And so without question, there is a kind of socioeconomic class that is taking the majority of the job losses, and these are the people that can least afford it, that don't have a social safety net. And that is obviously, the importance of the CARES Act and the increase in the amount and the duration of unemployment payments. That is the
an
buffer we
interesting
have.
parallel that you lay out here, right? I mean, if we were talking when you started writing the book, I think the worldview around automation and jobs, there's a chunk of jobs, and you say 25, it's somewhere in that range, right? 25, 30 million that will be automated away in the coming 20 years or something,
Yep.
right? That was the, and it's those jobs which are not knowledge worker jobs. So we spent a bunch of time just talking about work from home. Well, these are all knowledge workers.
Yep.
But the folks that are not able to do it from home, they're a different kind of worker and highly susceptible to automation. What are the industries? Restaurants, whatever. We just made that 20-year transition in the downside of it in 2 months.
Yep.
All those out there in the field, more than 25 million, 36 million, have been displaced and the jobs are gone. It's unclear whether they'll come back in quite the same way at the same pace. God willing, the 90% economy happens, but perhaps a lesson to draw from this is now more than ever, more urgent than ever, the retraining and repositioning of skills towards the new thing.
This is something, look, when people ask me, all right, look, it's nice you wrote this book. Book is available for pre-sale on Amazon now. Hashtag buy my book.
The end of jobs. The end of jobs. That's the name.
Yeah, it is an unfortunate title, quite frankly. I mean, it was always meant to be ironic because I did not think that many jobs were going to end, but it is not a title that I'm in love with, as 36 million Americans have lost their jobs over the last 8 weeks. But, I talk a lot in the book about how labor statistics don't move that quickly. When people say, oh, in the next 10 years, it's going to be 50. No, it never is. So stop making those predictions. Unless there is a mass dislocation, right? You can point to the Great Depression and you can look at the kinds of changes that were made to the social safety net and to a host of different things, union membership. Changes like that don't occur except in the case of a huge dislocation. We are seeing a dislocation much faster than we've ever seen one, right? We are still not at the total jobs loss on a percentage where we were in the Great Depression, but we never got this, to any place this quickly, right? It just doesn't happen. And so I am wary as people ask me, all right, well, what does this mean? What's the historical context? I'm like, look, we just don't know. We don't know how quickly a recovery will be. There will be a recovery. A lot of those jobs will come back. A lot of retail locations have declared bankruptcy. More will declare bankruptcy. People will not hire as many people back into parks and restaurants and all these other places, but they will hire a lot. We just don't know how many yet. And we don't know how the human behavior pattern will adopt to being in a somewhat crowded place, right? We don't know how consumers spend. We just don't know. That's always point one. When people say, what's going to happen? I'm like, we don't know. Anyone making any too broad a prediction, unless they have some foundational data, difficult to make. But point two is that it is accelerating existing trends. And remote work was one of those trends. It was a clear trend that was happening because of the infrastructure and the policies and procedures. And now it's a push versus just a pull. It will clearly increase. Robots and AI are another. Now, will people take this as an opportunity to go and spend the money to displace workers? I don't know. I think it is very difficult when people are making capital allocation decisions at retailers, at restaurants, at amusement parks, wherever, to say, well, should we go and spend $50 million to upgrade the entire thing? People are going to go, well, I'm not sure we should spend that money yet. So I am perfectly comfortable saying the cost versus benefit analysis of deploying robots and AI is starting to look more favorable for companies, because the costs suddenly need to incorporate the fact that if you had an entirely robotic workforce, you'd be completely open right now. And the benefits of staying open, all of a sudden makes sense, meaning a pandemic now needs to get priced into your cost benefit analysis. And so the cost benefit analysis will change. And on the margin, more people will adopt robots, but we haven't seen it yet. because nobody's
Oh,
going
I
to
mean,
make
we're
those capital
just a few weeks
allocations.
in. Yeah, I mean, we're just a few weeks in, and I guess we've got a long decline ahead in economic terms. But the point is interesting, and it hasn't been present in our discussion of essential workers, right? I mean, we are, or at least I am in New York on my balcony banging a pot at 7 p.m. for healthcare workers, and we're admiring the heroism of folks that in the past we considered doing something so mundane as stocking a shelf at a grocery store.
Right.
Some of those things were always most susceptible to automation, and I suppose that there is now more than just an economic consideration to accelerate that.
I
The
think
robot
as
at the grocery store doesn't get sick. The self-checkout, won't
right.
pass the disease to anyone.
I think
Um,
the
and it
capital
will have a
budgets.
very adverse, but that sounds like bad news for both the essential and the non-knowledge in the medium.
Look, this is something that was always going to happen over time. Do I think that on the margin in 2021, capital budgets as they're allocated will spend more on this? Yes. Do I think there's going to be a huge amount that happens in the near term? No. But it will accelerate an existing trend. But to your point, Amal, like the art of going to a restaurant, and we all look forward to being able to do that again soon, somebody giving you a piece of paper that lists everything the restaurant does, you communicating via voice to a human who writes it on a different piece of paper and then walks and gives that piece of paper to somebody in a kitchen that prepares that food. The technology to displace that has existed for 20 years. We could have had an iPad on that restaurant table 10 years ago. And some restaurants do this. There actually is a few fast food chains have done it, or quality QSR chains have done it. But for the most part, the waiter and waitress population in the United States has not changed. And so just because it can happen doesn't mean that it will. And I'll point to my favorite example that we talk about in the book, which is the ATM. So the ATM was invented on September 2nd, 1969. The first ATM was put in place in Rockville Center by Chemical Bank. It wasn't until the 1990s that it became popularized and was in every bank branch. In 1995, there were 500,000 bank tellers in the United States. And if you asked anybody making predictions in 1995, they would have said, oh my God, the number of bank tellers in the United States is going to fall. Over the next 20 years, the number of bank tellers in the United States increased 20%. There are currently 600,000 bank tellers in the United States. They mostly came out from behind the glass, and now they had iPads, and they were upselling you. The mundane task of taking money and dispersing money can almost completely move to the ATM, and they were able to do higher value, more customer focused tasks that clearly a robot could not. And so we might look at that and say, oh, well, that's an example of task shifting and upskilling. Maybe. Because also during that period, the number of bank branches in the United States increased almost 2x. As we both know, living in New York City, there's now a bank branch on every single corner. So the number of tellers per branch went from 21 to 13. So the number of bank tellers did drop precipitously. And so as you think about the interaction between the competitive dynamics in an industry, the regulations in the industry, the ability to upskill, it is incredibly complex. And any simple statement like, oh, because of this, then that, belays the complexity of any labor policy, any labor interaction. So there are no quick, easy statements to be made that, oh, well, clearly because of this, that's going to happen. It doesn't. It's incredibly complex.
Okay, so now, Jeff, we come to the next section of our interview, which is the quick and easy statements lightning round. Just kidding, but I do want to look forward for this next couple of quarters and get your judicious prognostications. We have lost 36 million jobs. How many are we going to lose?
42.
That's it?
42 is going to be the trough.
So we're 3 weeks out from that? 5 weeks out from that?
The rate is going to slow. And so, we obviously dropped from there's no words for 6 million people filing unemployment claims each week. And it's down to almost to 3 million. I think that'll continue to taper down. So I think it's going to take another, month and a half before we hit the bottom. But I think you're going to start to see that stabilize before the end of the quarter.
Has the complexion of job cuts changed over the previous 8 weeks, and then for the next few, I suspect in the first couple of weeks it was restaurants and stuff like that. But big giant corporates, I've been trying to watch for big reductions there, and I haven't seen so many. There are a couple that made huge changes, but
I think corporate, look, there's a balance between the business roundtable, proclamation of, hey, we're going to be really focused on our stakeholders and an understanding of the horrific things going on in the market. Morgan Stanley CEO publicly stating we will not make any reductions in force through this year, no matter what. You've seen companies like Facebook, companies like ADP give spot bonuses to the entirety of their workforce. And so those speak to companies standing by their team during this crisis. I don't think that we will see a huge number of companies outside of those sectors making changes unless people, that other part of the economy, that other 16%, if it doesn't come back almost at all, then you will see companies have to make adjustments going into Q3. But I think through Q2, people are pretty good as to where they're sitting right now.
So large corporates have not yet felt the pain. As real economy contraction unfolds, they might, and you may see some changes, is what I heard.
They may, it's important to emphasize that this is just simply Jeff Wald's prediction. I don't have access to ADP's Research Institute and all the data ADP has. This is just simply Jeff Wald reading papers and magazines.
Small companies versus big ones. I've had the sense that there is a growing small business apocalypse in the offing. Policy has varied around the world. Here in the US, we did something with a very short time horizon, 8 weeks of paycheck protection, whatever. Even unemployment, when people get on that, what is it? It's like, it's not substantially more than that duration. Maybe it's 15 weeks or something like that.
I don't know. My impression is under the CARES Act, it was substantially expanded in terms of the duration.
Which incentivizes small businesses to let people go to unemployment in a way.
Yeah.
So we're working kind of against ourselves with US policy. If large corporates are doing fine, what should we expect in small business land these next couple of quarters?
It's an interesting conversation because it's certainly one that a lot of people I've had conversations with people in the finance world where you just want to say, I don't understand the stock market. It's like, what is going on? Certainly prior to this week. And there are two things going on, right? It's important to remember the stock market is not a reflection of US economic activity. It is a reflection of the economic activity of a certain portion of companies, which the percent of companies that are public compared to total companies in the United States, it's de minimis, right? There are 12,000, 18,000 public companies traded in the United States out of the millions of companies. When you talk about existing trends being accelerated, concentration of economic activity in increasingly fewer companies is a trend that was clearly happening in the United States prior to this. It is accelerating now. A company sitting with $100 billion of cash on its balance sheet is infinitely better off than a company sitting, with debt that they can't pay back to the local bank. So there is an increasing concentration, and I think that is reflected in the stock market because, look, keep in mind, 20% of the S&P 500 is represented by 5 companies. So if Apple, Microsoft, Amazon, Google, and Facebook, are doing well, and they're all doing exceptionally well right now from a revenue standpoint, from a profit standpoint, it drives the S&P. So I do think that companies at the smaller size are struggling tremendously. I mean, my heart can't even go out enough to a small retailer. You're not able to open, you don't have an online presence, and when you reopen, if you even can, how many people are going to be comfortable coming in? How many people have shifted their behavior patterns entirely online? And so while restaurants, restaurants have always come and gone, I don't know the statistics here, new restaurants will open. Talk to me about someone that's sitting there saying, oh, when this is all over, I'm going to open a new retail operation. Nobody's going to do that.
There will be some pockets, but yeah, if I had to place a wager, I don't know if I'd be wagering for it.
And
so let's do full-time versus flex or freelance workforces, right? So Knotel spends a lot of time making the argument that flexibility is important. If you're going to have a workplace anywhere in the world, and now more than ever, you want Knotel to do it for you. You don't need these headaches. Let us help you make changes. World's uncertain. Well, this is the argument that you spent the last, I don't know, 10 years making as you were building WorkMarket. You were saying to companies, guys, the freelance and flexible workforce is hugely valuable to companies. Let us help you manage it better compliance, better experience. Well, is that a shift that's going to accelerate too? How much of the labor force was freelance a year ago? What's it going to be in the years to come, and why?
So this is one where I'm struggling to find data just yet. So there are, I think there is a movement afoot that is a stakeholder movement that large companies are increasingly going to, want to be looking after all of their stakeholders and making people employees. There is a movement afoot from a regulatory standpoint. AB 5 in California by far is the most well-known piece of regulation. Or legislation, I should say, but other states are moving forward with their own versions thereof. And so I think that there is somewhat of a compression going on in the on-demand labor force because companies view the regulatory risk has increased. I would dispute that completely, but that is a view that some companies hold. You have to weigh those factors against the fact that companies with a large fixed workforce right now are looking at their competitors who had a more variable workforce saying, whoa, they were able to adjust their cost structure like that overnight, and I can't do that. And so the idea of continuing to variabilize your cost structure by using more and more of a freelance workforce, a temp workforce, is certainly appealing at times when there is huge revenue dislocation. You want to make sure your costs
for sure.
Revenue.
Yeah, I mean, the need makes sense, but there's also now the opportunity, right? I mean, I don't know how you used to think about it when you were out hustling before you became a titan with your ADP colleagues, but the absorption rate of net hiring, let's say, into freelance type roles versus full-time type roles, whatever that mix was, I would suspect that even if that mix stayed the same, there's 36 million newly unemployed that as they find themselves back doing something, quite a lot of them will end up being freelance.
So ADP did by far the most exhaustive piece of research on this. And we looked at, because look, not only are we the largest provider of payroll to full-time employees, we are the largest provider of payments to 1099s. We issue more 1099s than anybody on the planet, well, in the United States, because it's a US form. And so we were able to look over the last 10 years and we found 3% market share gains. So that 10 years ago, 13% of enterprise employment, even bigger percent, I think about 11% of enterprise employment was freelance, and now it is about 16%. 2% of that growth is just economic growth. 3% of that growth was market share gains, meaning people moving W-2 employees over to 1099s. And so that is the data. It's available on ADP's Research Institute's website. It's super interesting and by far the biggest piece of research done on the on-demand space. The other things that had always been done in the on-demand space is the Freelancers Union did a study every year, MBO Partners did a study every year, and they always found, and the Bureau of Labor Statistics did a study once in 2015, once in 2018. In study after study, they found that 80% of people that had a flexible work arrangement would not take a full-time job if offered. And as I state in the book and certainly state on stage prior to the crisis, I always said, look, keep in mind, those surveys were always done in an economic expansion. They were always asked the question when it was easy to say, no, I want to choose a flexible work. I want to choose my own schedule. I want to choose which clients I work for. How many of those freelancers are making that statement now? I don't know, but I would bet that it's much lower than 80%. And so as companies start to bring back workers, yes, they will look to variabilize their cost structure as companies always have. But the regulatory framework here cannot be overemphasized. You can't just simply, and I have never, in my 10 years of running WorkMarket, I've never once heard a company say, hey, I've got all these W-2s and I want to switch them to 1099s, so I need your software. Never. That has never happened. I have heard companies say, hey, I'm getting very concerned with the regulatory environment, so I want to change my 1099s to W-2s. That I have heard. Not that much, but I've heard it. And so the regulatory environment really does drive corporate behavior. And it is very clear who can be a 1099 and who cannot. And so you can't just say, hey, I'm going to bring everybody back, but you're all 1099s. Like that will not happen.
The world is more complicated than the binaries, I suppose, that we get from the headline makers on virtually every topic we've discussed. So one last quick, easy answer in my quiz for you, Jeff. When is US GDP positive again? That's the first
when
quarter
does it
with
get back to where
plus.
It was?
No, just plus, just
just
a year-on-year plus.
Oh,
yeah, so for example,
Q3.
Q1 was -5. Well, this last Q1 was -5% versus year ago.
Yep.
But it was -1% versus the quarter prior.
Right.
This one's going to be bad, and you think
Perfect.
Q3 will be plus?
I think it'll be
a
plus.
Number?
I don't. I'm gonna.
So
I will,
V-shape, but then that's V-shape. I mean,
well, it's not going to be plus
surprised.
enough to get you back to where you were.
Uh-huh.
You know, I think it's going to be. I think there will be economic expansion, but from an incredibly low base, because I think Q2 is going to be horrific. But I think you get back to positive growth, but I don't think you get back to where we were for 2 or 3 years.
We have been recording our conversation with Jeff Wald, author of The End of Jobs, part of this Flex Forward series. And Jeff, the recording will let us hold you accountable for all your quick and easy answers, predictions about the near term and the long term future. Thank you for being here with us.
You know, I love quick and easy answers. So absolutely. Thank you so much for having me. I love this series and I was super honored to be a part of it.
And thanks everyone for joining. Bye.